Welcome back. Well, no relief for local consumers. That's as the South African Reserve Bank kept rates on hold, citing inflation risks that remain to the upside. This was a unanimous move, leaving the repo rate at 8.25%. Joining me now as we unpack the decision in greater detail is Senior Economist at FNB, Koketso Mano. Thank you so much for your time, Koketso. Of course, this expected by the markets. We were not expecting anything different. And of course, I guess, economists and investors were sifting through the comments and the outlook that the governor presented there. A unanimous decision to keep rates on hold. Does this outline maybe the hawkishness of the Sarb at this point?
Yeah, definitely. I think going into the meeting, we broadly expected a relatively hawkish statement, given that, we tend to update our forecast a bit more frequently than the MPC. We had seen some of the red flags coming up. So broadly as expected, the MPC sounded a bit hawkish. All of them decided that it was best to keep interest rates unchanged. It's not a surprise for the market, but I guess the more interesting things to pick up from the MPC statement today is around the forecasts, where they have upgraded the output or growth forecast for this year. They are saying that the electricity constraint on the economy is going to be less this year. They estimated at 1.5 percentage points last year, and now they expect it to fall below 1% at 0.1 percentage points at 0.6 percentage points in 2024, and they expect that to continue over the forecast period. The other change that they've made is they've lifted the inflation forecast, and as I said, we broadly expected that, especially given that the first quarter estimate that they had at the January MPC was looking already a bit suspect with the February numbers that came out last week. So a very uninteresting or uneventful MPC, but yes, a few things to pull out nevertheless.
Yeah, boring overall, but like when you look at the details, of course, things not so boring. Inflation. You talk about the lifting of the forecast there. What are the biggest upside risks for inflation at this point?
Yeah, definitely. And maybe let's start off with the adjustment in itself, right? They did mention that services inflation is starting to normalize. It's something that we had expected post the pandemic, especially with those supply chain disruptions. But relative to other markets, I mean, South Africa didn't see that really strong pickup in core inflation, and we thought, a lot of the underlying demand pressures were just not there. We were even talking about it last year, saying that core inflation had been underwhelming. But now finally it seems as though services inflation is starting to normalize, and the risks, as you have asked now, is that you could still see core goods inflation remaining relatively sticky, simply because of a very undervalued exchange rate, which the MPC flagged as well. At the global level, the MPC continues to say that inflation continues to be a concern. So for the imported piece of inflation, that still is going to be an upside risk to the outlook. And then the second one that they mentioned is food inflation, right? We did have hostile weather conditions at the start of this year. We've already seen how that has affected, crop estimates that have come out. And so towards the middle of the year and in the latter part of the year, you could see food inflation not really coming off as high as much as we had expected. So overall, when you have services inflation normalizing at the same time that you could have core goods inflation remaining relatively sticky, the net result is that inflation does not disinflate as strongly as you would have expected in the later part of this year, and that would have implications for policy.
Well, talking about policy, and of course we have been talking about a change in policy. Hawkish tone now, but was it hawkish enough for market participants to kind of shift their expectations for interest rate cuts further than July?
I think the interesting thing is in the later part of 2023, the market, or let me rather say analysts, expectations were that the MPC could cut as early as the first quarter of 2024. We had at that stage anticipated that they could wait for, the elections to pass. The date was not confirmed yet, but we anticipated that it could be in the second quarter. So we thought they'd wait for all that risk, the impact that it'd have on the rand to pass before they start cutting. And we estimated that to be around July. So now the interesting thing is that after this January MPC and also the February numbers on inflation, we've seen a great shift in those expectations moving into the latter part of 2024, even further than what we ourselves anticipate. So you see analysts shifting towards September, November, even the MPC's QPM is showing that you could, have a shallower cutting cycle than what we previously anticipated. So it seems to be that, these inflation outcomes and the upside inflation risk is really indeed pushing out expectations for cuts. And what also does not help on top of that is hawkish tones coming through from the Fed, for example, in the latest forecast, where you see they've increased the expectations for interest rates over the longer run. The Bank of Japan has shifted to positive territory in terms of interest rates. So yeah, the global picture is basically pushing us towards the theme of higher for longer.
Well, an interesting thing that the governor did say is that the Sarb does not follow the Fed, but it watches the Fed. How closely, though, should they watch the Fed, considering that he also mentioned that there are some emerging market central banks that have started cutting?
Yeah, definitely. I think in terms of watching the Fed is about, how prominent the Fed is, or even the dollar is globally, right? So when investors unfortunately look at the greater spectrum of where to send their money or where to keep their savings, in a period of high interest rates in the United States, where there is less risk for those savings, you are unfortunately, as a riskier market, a riskier emerging market like South Africa, having to compete for those savings. So unfortunately, it does have a bearing for where we leave our interest rates. In fact, when you think about the previous decade that we've just come out of, where you had zero lower bound, you had quantitative easing, you had Japan implementing negative interest rates, that decade was a decade of cheap money, right? But we've moved out of that. We're seeing higher interest rates, even in real terms over the longer run. So unfortunately, a country like South Africa is going to have to look at those dynamics, especially when you're looking at our current account deficit, our fiscal deficit. We need those savings, and we're going to have to find a way to attract them.
Hey, another period of expensive money. Thank you so much for your time and for your insights there, Koketso. Really appreciate it. That was Senior Economist at FNB, Koketso Mano.